Hey, while we're waiting for him to come on, let me I'll kind of talk to you because I actually sell a lot of this product. I absolutely love this product, so I want to kind of walk you through why I would sell this product. The number one reason that people uh, deplete their assets in the retirement years is because of long-term care, and there's nothing a second close, a close second. It is the number one reason is due to long-term care. Now, if I would ask each of you, who do you know that's been in a nursing home, had to receive home health care, had to receive some type of assisted care, adult daycare, hospice care? All of you are going to know somebody, whether it's a family member, whether it's a client, something. And so there's so many people out there that unfortunately they lose their entire assets and they have to spend down to Medicaid. Do you ever know of anybody having to spend down to Medicaid because of, for financial? And so what it took them a lifetime to build, they can, it goes away in just a very, very short period of time. And one thing I'd strongly encourage you to do is kind of Google what the average cost of long-term care is in your area. And it's going to be, some people pay 70, 80,000 a year. Some people pay, 90 to 100,000, depends on what part of the country you're in. But one of the things that here's where I kind of, every time I meet with a client, I say this right here. And these are two very simple questions. I want to kind of walk you through this real fast. First question I ask them is, do you currently have any long-term care coverage? I'm just simply asking a simple question. Do you have long-term care? And if they say no, I ask them what their long-term care plan is. And that's what always kind of gets them to where most of them don't have a plan. And so then the next question I'm going to ask them this, so the first one is, do you have long-term care? And the next one I want to ask them is, do you have any lazy money? And I'm asking this question for a couple of reasons. Number one is, I want to find out, because they're all of a sudden going to start telling me what monies they have. And so it's an easy question to ask them, do you have any lazy monies? And so what I mean by lazy monies is, and so they're going to start telling you where their monies are at, how much they have, and so forth. And so then I'm saying, well, what I'm looking for to help you protect your long-term care, I'm looking for some money that you've got set aside that's not really, it's not earmarked for you to build a house here in 6 months, for you to that you're going to buy a new vehicle with, or do some home remodeling. It's money that's not earmarked for anything. It's money, kind of emergency type money, to an event that you need, that you have to have long-term care money that you, and a lot of people have, $100,000 or whatever setting aside that's not really earmarked for anything. And so what I love about this product, and hopefully he'll join real soon, but what I love about this product is, it is, if you have traditional long-term care, so there's three types of long-term care products. It's traditional long-term care. And what I don't like about traditional long-term care, and I actually own traditional long-term care because when I bought mine, that was all that was available. Okay. We didn't have these hybrid products back in the, before some of y'all were born, back in the 90s. And so we didn't look at Hunter laughing there. So, didn't have these products back when I started the insurance business. So I did buy traditional long-term care insurance. Now, the negative traditional long-term care insurance is, number one, is subject to rate increases. There are going to be rate increases that continue to pile on. Number two, what I don't like about it is a use it or lose it product, and under most circumstances, probably 99% of the time, it's a use it or lose it. He's actually on now. Okay, so Adam, I'm going to talk just for a second. Then we'll turn it over to you here in just a second. So one of the things is I don't like about traditional long-term care, again, what I mentioned are two things. Is number one is they're subject to rate increases, and if you've sold traditional long-term care, a large percentage of those products have had drastic rate increases over the past several years, because when long-term care came out, they did not price these products accurately, and the cost of care obviously has just escalated beyond belief. But the rate increases, and so some people's taken 10, 20, 30, 40% rate increases. So something else, like I mentioned earlier, it's a use or lose it. So if you go through an entire life, and let's just say you get into your 70s and you die in an auto accident, you never used your long-term care, you've coverage, just kind of like home and auto insurance, you've had the coverage, but the company's keeping all of your money. And what I love about the One America Asset Care product, it's not a use it or lose it. And so it's a product to where, and this is what I love about it the most, if you go through an entire life and you don't use your long-term care product, you don't use your policy, there's a death benefit there for your family. So it's basically a non-interest bearing account, but you have long-term care protection, which is tremendous, which Adam's going to walk you through all this. But probably the greatest feature I love about this product is the continuation of the lifetime continuation of benefits, and to where you can have a lifetime benefit on this product, and where not many, like traditional long-term care doesn't even sell lifetime benefits anymore. So Adam, I'm going to turn it over to you. You can share your screen and kind of walk through these proposals, whatever you want to do. And then we do want to open it up for questions toward the end. And so as Adam's going through this, write down your questions, because guys and ladies, I'm telling you, if you start selling this product, it is probably, if not the best, it's one of the best long-term care products out there. And you have so many clients that have a need. It is unbelievable. And I'm telling you that once you do this, you have drastically helped your client. So Adam, it's all you.
Okay, so this is AssetCare. I mean, this is our illustration. It's 5 pages long, but basically the summary page, this just talks about the benefits that all the carriers have. But basically the summary page you're gonna find on page 3. Is this big enough for everybody?
Yep, it's perfect.
All right. Let me start with, so with AssetCare, there's 3 different ways to really fund it. You know, you have your single premium, then you have your recurring premium, then you have, you know, option for qualified funds, which is called AssetCare's annuity funding whole life. But I'm gonna start with the single premium. They all pretty much work the same way, just depends how you fund them. So AssetCare is a whole life policy. It's a hybrid product. So when you buy AssetCare, you get a face amount here, and this is just an example of a by client age 65, female 62. So you have your face amount of 193,000. And basically the way this product works, where you get your monthly benefit, is your times in this face amount times 3%. That's the acceleration rate, because we're accelerating the death benefit. And that's what gets you your monthly benefit of $5,790 a month. So, and on this quote, so for joint clients, the AOB, which stands for acceleration of benefits, because again, we're just accelerating the whole life death benefit, is 33 months. For single clients, it's going to be 25 months, but for this example, for joint clients, AOB is always going to be 33 months. Once the 33 months goes away, which it will slowly, because if the monthly benefit is, you know, say it's $6,000, this $6,000 is going to come out of the face amount. So when the face amount drops to 0, which should happen in about 33 months, that's when the clients transfer over from the AOB to the COB, which just stands for continuation of benefits. So in this example, the clients will have a total of 66 months combined total long-term care split between the 2 of them. And they can split that however they want. So she might use, you know, all the 66 months or vice versa, but to share a pool of money. So, and as you can see down here on the bottom left, since again, it's a whole life policy, this is what's actually getting paid towards the whole life policy. This is what's paying for the COB, you know, and this total premium here is for $150,000. So that's a pretty common quote. Before I go any further, does anybody have any questions so far? Nope. Okay. Well, another quote I ran that's almost identical, because what we really, because the reason we have this one is because, you know, there's a lot of carriers that have, you know, 4-year plan, 5-year plan, 6-year plan. So we kind of have this one so we can kind of compete with that duration, but where we really shine is with our lifetime benefits. So again, you're going to see the AOB, it's going to be 33 months. Then for the COB this time, instead of being limited to 33 months, you have lifetime benefits. So, you know, she might be on claim for 10 years, he might be on for 7 years, but it's what it sounds like. It's lifetime, it's unlimited. You know, we have a lady on claim right now. She does Alzheimer's. She's been on claim for 16 years. I think we paid her over 2.2 million in benefits. And that's the beauty of this product. That's where we kind of stick out. The 2 places we kind of stick out with our company is joint coverage. We have a lot of leverage with joint coverage, then our lifetime benefits. So this is for AssetCare single premium. The recurring premium almost looks identical. It's just, in this case, we're paying it differently. We're paying it on an annual basis. This one has the same benefits, same everything. This is the 33 plus 33. And then, most people like to pay monthly. So if you go down to page 5, you can see what the monthly amount's going to be. And you're seeing this become more and more popular. Used to be the single premium was the most popular way to fund asset care. But people tend now to seem to want to hang on to their money and pay on a recurring basis. And the big one that we have that no one else has, at least to the extent that we have it, is full waiver of premium. Meaning if anybody goes on claim, all premiums are waived. Is that some parts are waived or whatever, everything's waived.
Hey, can you repeat that again?
Yeah, so this product, and actually all of our asset care products come with a full waiver of premium. So anytime any one of these insureds go on claim, all the premiums stop. It used to be an optional, 2.5 years ago, you used to have to pay extra for it, but now we include it with the product, which is a huge selling feature.
Hey, and one other thing I want to point out, which is on the illustration, but premiums are guaranteed never to increase, which really caught my attention because I've been selling long-term care for 32 years. And the long-term care that I sold years and years ago, I've had lots of clients who've taken rate increases. On this one, the premiums are guaranteed never to increase because it is part of a whole life policy.
And thanks, Brian, for helping with that, because I get that question a lot. Like, clients have money with Genworth, their premiums just double, out of nowhere. And I get a question a lot. So when will these premiums go up, or this and that? It's like, to me, this is the only thing I've ever sold. So I'm like, what are you talking about? It's like, yeah, premiums with other, products do go up in price, but these are guaranteed never to change. Everything's guaranteed in the illustration. Again, asset care, there's 3 different types. So I showed the single premium. This is the recurring premium. Then we have our, asset care for qualified funds, which is the same design. I didn't run a sample one, but let me pull one up. So the way this one's a little bit different is you're basically going to buy a, it's qualified funds. It's coming over from a qualified account, which is going to transfer over to us all tax-free to a qualified annuity. That qualified annuity over the course of 10 years, it's going to make 10 distributions, which pays for the whole life policy. So I can get into the nitty gritty, but bottom line is we do have an option for qualified funds. And their question that gets asked a lot with this one is, what's his, IRA money or 401k? Can they both be covered? The answer is yes. And another question that will come up is, he got declined, but she didn't. Can they still use his money? And the answer is still yes. So really, any type of money they have, we can take it, we can put it into asset care.
Okay. Hey, and real quick, just so everybody knows what qualified money is money that is the taxes have not yet been paid. So that may be money that's in a 401k, money in some type of a qualified plan to where taxes were deferred. So the other products were designed for non-qualified monies, which means that taxes have already been paid. So just want to make sure everybody kind of understands just between qualified and non-qualified. So
Adam, can you go back to that other screen really quickly, please?
For this one?
Yeah, and can you repeat what you said? This was the qualified money?
It is. So this product is a little bit more complicated. This is for the qualified funds. And basically you're buying 2 products at the same time. So if you have a 401k, what we're going to do is transfer it over to a qualified annuity here at One America. And it actually acts like a 10-pay that's going to fund a whole life policy over 10 years. So actually, if you look at this quote, you can actually see on this side, you have both account values working at the same time. You have your annuity, you have your whole life policy. But at the end of 10 years, you have a 100% whole life policy. And each year, the client does get a 1099 for this distribution. And another nice thing about this product, this also does come with waiver premium. So the clients go on claim within, say 5 years, instead of this, call it 12,000 getting paid to the whole life policy or basically One America, that money would go straight to the client instead. And another thing with this product too, is it does get a 10% bonus on the distributions. So if you were to add this up, divided by 10, your distributions be 10,600. But because of that 10% bonus, you get a little bump in the distribution. I know I went a little faster. Did anybody have any questions on that one?
Well, you said that even if one of the spouses was declined. So for example, say they wanted to use money from William's 401k, but he
Uh-huh.
ended up getting declined, you could still cover Cynthia.
That's correct. Yeah, because he would remain the owner on that annuity. And then when we set the whole life policy, they'd both be the owner. Well, yeah, it should be the owner on the whole life policy and the only insured on the whole life policy, but he would own the annuity part of it. So to answer your question, yes, we can still do it.
And what's the minimum age? Like, what would the minimum age be for issuing these without getting any penalties?
Yes, the minimum age on this is 55, which kind of brings up the question, well, what's going to happen? Do they still get that 10% penalty, for taking distributions before 59.5? The answer is yes, they would, but we do have a way around it where we can actually defer these distributions where the client pays out of pocket. For example, if they're like, 58 and they want to defer the first 2 years, they can actually pay this amount out of their own pocket the first 2 years to avoid that penalty, then they would get it on the back end. But the minimum age is 55 and the spouse has to be at least 50. For all the
Okay,
other
so it's
asset care,
55, but they could still get a penalty if it was, if until 59 and a half.
they do. And most people actually choose just to take the penalty because, a lot of people just don't want to pay 12,000 a year just to avoid that 10% penalty. So, but yeah, minimum age on this for the owner is 55. For all the other asset care, the single premium and recurring premium, the minimum age is 30, maximum age is 80.
Hey, Hunter had a couple of questions, but after that, I'd like to go back to number 2 and really walk through that proposal in full detail because that's the one I've sold the most of.
Okay, so is it the
Proposal number
recurring?
2.
Okay,
Yeah, that's the
Okay.
one that I've sold a lot of, and that's the one that and again, there's all kinds of different ways to do this, but I'd like to walk through this. I'd like to go even back to page 1 and walk through all 6 pages because I want them to because it's going to generate a lot of conversation here. But Hunter, I think you had a couple of questions.
Yeah. I guess I'm confused. What's the differentiating factor between the 33 set months or the 50 months versus the lifetime?
okay.
Was that a single pay versus recurring, or what causes that? Or is it a different product in general?
No, it's all the same product. And so basically, you have your whole life policy. So by itself, so the COB is separate. It's a rider. You don't have to add it on there. I could show you a quote that only had 33 months and that's it. But with this product, you can add the rider or what's called the COB, which gives you the leverage to have longer long-term care duration. So the base or the AOB is just your whole life policy and you're accelerating the death benefit by 3%, which gives you your monthly benefit. So you really kind of have like 2 working on the same time. You have your base or what we call the AOB, then you have your COB once you're done with the base policy. Does that make more sense?
It does, absolutely. Now, what's the cost difference for that rider versus leaving it out?
Well, in this case, okay, so the total premium is 150,000. So you have 83,000 that's being paid towards the whole life policy. And for that rider, costs $66,000.
That makes sense.
Okay. And then Israel had a question. He says and I don't know if it's Israel, you want to ask your question or you may ask it for you?
Yeah, I'm just trying to understand how the benefits are distributed when care is needed.
Okay. Hey, let's do this, Israel. Let's walk through this proposal page by page, and I think that'll answer your question. But if not, we'll come back to that question. But I think it will, because this is what I really wanted Adam to walk through this illustration in full details. So as you'll see on page 1, this is just information. So go down just a little bit, Adam. And so page 1 is just the cover page. So if it goes to page 2, and this is a page that I think is going to answer your question, Israel. How does asset care work? And so, Adam, if you can just kind of walk through this page in full detail and let people ask questions. I just want them to when they're getting in front of a client to really understand the proposal more than anything.
Oh, sure. So I mean, I guess to answer your question first, what triggers benefits is if you can't perform 2 out of the 6 ADLs, or you have some sort of cognitive impairment like Alzheimer's or, whatever it is. Are you guys familiar with the 2 out of 6 ADLs, activities of daily living? So that's what's going to trigger once your doctor signs off on that. That's what's going to trigger benefits. And so before that even happens, or even if the client is thinking about going on long-term care, you just call our claim specialist and they'll walk them through it A to Z. We have a great claims, customer service team. You get like a dedicated person to make sure that everything goes smoothly because, when you get to that age, it seems complicated, but it's really not. They're going to basically handhold from start to finish to make sure that the claims get paid. And we are reimbursement, and we can set that up directly with the facility care so that clients don't have to like get a bill, do a reimbursement. They can do it that way. It's just a lot more paperwork and more of a headache, but they can just coordinate that with us with One America directly, so they don't have to worry about that part of it. But that's what triggers claims. You have the 2006 ADLs or some sort of cognitive impairment. Down here, the elimination period, it's 0 for home healthcare and 90 days for facility care. But there's more to this than what kind of meets the eye, because 80% of the time when people go on claim, they start off in home healthcare. I think 80% of the time, those days, those service days that are in home healthcare does count towards the waiting period for the facility care, which is 90 days. So if you have someone that's on home healthcare for 120 days, then they're transferring over to facility care, that elimination period's already been met. It's kind of a big factor in this product.
And yeah, go ahead and walk through that section there, the more than just a nursing home, just to make sure they understand it's more than just nursing home.
Yeah, it just talks about all the benefits that the clients can get. You got home health care, assisted living, nursing home, adult daycare, hospice. Even like we'll pay for, and this is just an example, we'll pay family members to train them on how they can take care of their, loved ones when they're at home. And we have a program where we can pay them for, say they're taking care of mom and dad for 6 months and they just need a break. We'll actually pay them to take a break, So it pays for a lot more than just home health care and facility care. There's a lot that it pays for.
And one of the great things on that bottom left-hand corner talks about the tax-free long-term care benefits. So these are tax-free long-term care benefits. And then also the death benefit is tax-free. So
That's correct.
And so go ahead and go down this next page here. Now, one thing I'll point out here, just to make sure that now the reason that if you click on number 2 and go to page 3, and then I'm going to go back and I'm going to show them something real fast here. Click on that number 1 there.
Okay.
So on number 1, you'll see that the face amount, the initial premium is 150,000, but the face amount is 193,000. If you go back to number 2, you'll see that the face amount now is 154,000. So I'm giving up 39,000 a face. But what am I getting because of giving that up? That's where I'm getting that unlimited continuation of benefits. I would rather give up the unlimited continuation benefits. So the way I describe it to my clients, I'll say, okay, Miss Prospect, let me ask you a question. You said you needed, and I'm just throwing ideas out here, $4,600 a month of care. Let's just say 5,000, whatever the number may be. And so if you have $500 or $150,000 that you can deposit in, then it's a non-interest rate bearing account scenario, or a best case scenario, whichever way you want to look at it. So you give me 150,000, worst case scenario, your family's get 154,000. So that's not a big deal. Okay. So that's not, you're only making $4,000. So, obviously that's not a good investment there, for me to give you 150,000 and 20 years later, you give me 154,000 back. That's not a good investment. But here's where the great investment is, and where you really protect yourself. You protect all the assets you built all of your life. Let's just say that, they're getting $55,000 a year and you put in $150,000. It doesn't take, but it takes less than 3 years for you to get your money back. Okay. So let's just say that you and or your spouse is on care. Let's just say the two of you are on care total. Say the spouse is on care for 6 years and you're on care for 3 years. That's 9 years of care at $55,000 a year, at 9 years of care. So now you've gotten $499,000 back, paid to you. So you've received back $499,000. And so that's more than 3 times what you put in. So, Mr. Prospect, what you're really doing is you're protecting yourself. You're taking a small portion of your assets and you're protecting a lifetime of income. You're protecting And again, like I had mentioned earlier, they've got a client, and obviously that's an isolated incident, but has received over $2 million in benefit. Doesn't take long to get your money back in the event that you need it. But the reason I love the unlimited is because there's some people that only spend a couple of years in nursing home. There's some people who spend 10, 12, 15, 20 years in nursing homes. And I'm using nursing home. It doesn't have to be nursing home, but whatever it is. So that's the reason I love this product, is that right there. But Adam, go ahead and I think you've kind of walked through this one already, but before we leave this, does anybody have any questions on how this works? So basically, and I'll kind of rehash what Adam's already said, is if one's on claim, they're getting 4621. If they're both on claim, they're getting 9241, which is $110,000, $11,000 a year. And they both have lifetime benefits. They're paying $150,000. If neither one of them ever use a product, they're getting $154,000 back. And one thing I'll tell you about the underwriting real fast, just while it's on my mind, is One America is not guaranteed issue in any stretch of imagination, but it is the most simplified underwriting, the most lenient underwriting of any long-term care product in the market that I've seen, and I've seen a lot of them. Okay, again, it's not guaranteed issue. So if you've got a person that's already cognitively impaired, they're not getting approved, obviously. It's kind of like, buying a car after the accident happens, car insurance. But and then I think somebody had a question, does it have an inflation rider? And the answer is no rider on it. So,
Well, the
you
inflation,
can put it, but this one doesn't have it. So
yeah, this one doesn't, but yeah, we can add an inflation on there on both the AOB or COB.
Okay. And then Joshua said, send over the contracts for his team. So we will definitely do that. So let's go ahead. Before we leave this page, any questions on this page at all? Because I'm telling you, team, this is this unbelievable product. I know, boy, I love this product, but go ahead. Any questions? Does everybody understand? If you don't understand it, now's the time, because the question, what you don't understand, somebody else probably doesn't understand. Does everybody understand the acceleration benefits, the continuation of benefits? I don't want to beat dead horses here, but does everybody understand all those? Okay, Adam, I think everybody understands. So let's go to page 4. Okay, so Adam, if you want to kind of walk through this page here.
Okay, yeah, this is the ledger page. This just shows, this is a single premium that we're putting in, shows the cash surrender value. One thing I'll just say about the cash surrender value is, with the whole life policy, you can't take loans. Our loan rate is 7.2%. So they can get a loan up to as much as the cash surrender value. If they do that, they just want to make sure they pay it back before they go on claim, because say if they take a 20% of that, well, the benefits will be reduced by 20% if you don't pay the loan back. Here it's going to show the death benefit. Death benefit never changes. Long-term care balance, this is lifetime, so it's unlimited. And this just shows you the monthly benefit for both the AOB and COB. For younger couples, we typically will usually put 3% inflation only on the COB. And so you'd see this go up over time. And the reason we don't like to put on the AOB as well is because honestly, it's really expensive to have inflation on both. And most of the time when people start on claim, like I said before, 80% of the time it's at home healthcare where cost isn't as high. It's when they go in facility care where costs obviously increase. So that's why we like to add inflation just on the COB. So that's page 4. I went through that kind of fast. Anybody have any questions about that?
Your questions, now's your time to ask them. Anybody have any questions?
Like Brian said before too, everything is guaranteed, because a lot of people think this could change. These numbers will not change. It's all guaranteed.
And that's another thing I love about this product. The entire illustration is fully guaranteed. It's not based on an interest rate. It's not based on the economy or anything else. It's not based on any market conditions. It is 100% guaranteed, every number you see on here.
We good on this page?
I think we're good.
All right. This page is like a matrix page. So if you want to know what this quote would look like, but say if you were to add inflation, like I mentioned before, on just the COB, the cost of that being 150, which we found on page 3, get at 3% inflation in the COB, it'd be 193,000. And there's two types of inflation. We have inflation for 20 years. You have lifetime inflation. Obviously, if someone's like 70 years old, they probably wouldn't want to go with the lifetime option. They probably only need it for 20 years. It's just a way for them to save money, so we're not having lifetime inflation. But this is the matrix base that just shows you all the different options. So you don't have to run 20 quotes to see, 20 different numbers. I wouldn't recommend showing this to clients because it is confusing. It took me a while to understand it, honestly. But for you yourself, if you just want to know in your head, like, okay, how much would inflation cost? This is a quick way to know. Most of the time, I'll just send multiple illustration. Here's your quote with no inflation. Here's your quote with inflation. Just to me, easier to look at, but you do have this as an option. But yeah, just a matrix page.
And one
Anybody
thing
have
to keep in mind is lifetime. So make sure you're looking at that. And again, I focus strictly on the lifetime, but I think somebody was about to have a question. Any questions at all? Okay, go ahead and go to the final page.
Final page is full of fund disclosures and pretty much what you put in. These are your inputs on what you put in to get your quote. So that's about it on this page. A question that does come up. Okay, you see this right here at the very bottom where it says this is not an illustration. Kind of scares people. The reason it's considered not an illustration, we just call them quotes, is because there are rules with the NC, I forget which department it is.
NAIC.
Yeah, thank you. We don't meet all of them. We meet close to them, but we don't meet all of them. That's why legally we have to put this in there. But it does come up a lot. And somewhere else on this illustration, it does mention how, I think it's towards the top, how values could go down. But basically what that means, if I could find it, that'd be great. But basically what that means, if someone takes a withdrawal or a loan from the account, that's how the values go down, which is kind of scary language that values could go down. Sounds like, what are you talking about? Out of where? Well, that's if you just take a withdrawal. That's what they're talking about. So just a couple common questions that come up with this illustration.
Okay. And one last thing real quick, and then we'll see if there's any final questions and we'll dismiss. The only thing I encourage everyone to do is simply start asking the question, what's your long-term care plan? What do you have long-term care insurance? Some type of question like that, just to generate the conversation. Once you get the client, and let's just say the client is interested in long-term care, all you have to simply do is find out where their money's at. If they're candidates to pay a lump sum, which is always the best, or if they would prefer to pay an annual or monthly type payment, but find out what they're because everybody has a story. Find out what their story is. Find out what's important to them, and that's where listening to clients is so important, because they're going to have a story and they're going to say something in that meeting that's going to generate some interest. And when you go back, you're able to kind of hone in on whatever that was important to them and why this would be a great solution for them. So the next thing, so after you got, we can contact First Heartland. They'll run proposals for us. We can run them ourselves. It's pretty simple either way. But what I was going to tell you is, if you have a client that's interested and you want to present this, I'd be glad to get on a Zoom call with you. 100%. I'll get on the Zoom call with you. I'll go through the entire presentation. I'll help you close the deal. You just need to have the application handy with you at the time, because chances are we'll sell it. And but just if you have an interested client, I'd be glad to jump on a call with you. I'd be glad to do a training beforehand with you and let you present it, whatever you want to do. And then Adam, I'll make sure everybody, Adam, is it okay if they call you with questions also?
Absolutely. Yeah,
Okay.
absolutely.
So I'll make sure everybody gets Adam's number, but if you have questions, feel free to reach out to us. We'll be glad to help. Any final questions at all? Anybody? Okay. Adam, I appreciate very much you jumping on the call. We'll get a copy of the recording out to everyone. We'll send the illustrations out. We'll send everything out to you. So if anybody has any questions, just let us know. Thanks, everybody. Hope you have a tremendous day, and thanks for your partnership.
Thanks, guys. See ya.
Thanks, Adam.